For more on today's sell-off, let's bring in Doug Ostrover, Blue Owl, co-founder and CEO. Blue Owl is an alternative asset management firm which just had its investor day today. Doug, thank you for joining us. It's good to talk to you again.
Well, it's nice to be back, and I was hoping for a big update with our investor day, but I see now that I've come on the air, our stock is actually up 3 cents on the day. So I will take that as a victory.
All right, Doug. So tell us how the volatility and the changing rate environment is impacting your business.
Well, listen, I was listening to the show before I came on, and, we are not in the equity markets. We are an alternative business. We focused on 3 core categories. We have a direct lending business, which I'll touch on in a moment, which is actually benefiting in this environment. We have a GP solutions business where we take stakes in very large cap alternative managers, and we have a triple net lease business. And I have to tell you, when we talked about this today at Investor Day, a lot of companies are coming out and lowering guidance, and there's obviously a lot of headwinds. We actually have a lot of tailwinds in our business. And so we up guidance today, and I'd say people came away pretty pleased. Let me just comment one thing on what we're seeing on lending, because that's our biggest vertical. As rates go higher, one of the benefits for us is all of our debt, all the loans we make are senior secured and floating rate. And so our investors benefit. We float off of 3-month or 6-month LIBOR or SOFR. And so our investors are getting higher and higher returns. The second part of this is, with so much volatility, so much uncertainty, the banks have pulled back. They started to pull back. You'll remember this in 2008. It's gone on for a long time. But right now, if a company's asking for a bank to put a commitment on their books, how does the bank do that? Because their goal is to turn around and lay it off.
So you step in there.
And we're in it for the long haul. And you've probably seen that, recently we led a deal for a company called Anaplan with Thoma Bravo. This is a buyout. Thoma Bravo is buying a world-class software business, $10+ billion. This is.
You've seen more of those, Doug, as the software valuations have come down?
We have announced 3, and I can tell you we are working on quite a few deals. And the size of those deals range from a couple billion to well in excess of $10 billion. Think about that. Like a few years ago, would you ever thought that direct lenders would be in a position to be stepping in and providing the capital to buyouts, greater than $10 billion? But that is the case today. And if the market stays volatile, I think,
just more opportunities.
Well, yeah.
So tell us about the dividend, which a lot of people like your stock for, growing it. How much confidence that you have that you will not have to cut the dividend in this uncertain environment?
Well, for us, cutting the dividend, it would be, in my mind, nearly impossible. And the reason for that is, 95% of our revenue comes from permanent capital streams, and all of our income comes from management fees. So think about a long-dated pool of capital where all of the revenue is from management fee. So just to give you a great example, I laid this out at Investor Day today. We did $523 million of distributable earnings last year. We will earn that $523 million for the next 10, 15, 20 years. So the question is, how do we grow it? Well, we have other pools of capital we'll deploy and start earning fees, and that will roll into that annuity. Can we grow beyond that? And then, continue to look for accretive acquisitions. So just to give you an idea, today we talked about getting to $1 dividend per share. So I'll ask you a question. If we get to $1 dividend a share, can you see any scenario off of permanent capital, long-dated pools of capital, where we can trade at $10 or $11? I just don't see it.
It's a CEO's guarantee. Well, speaking of your trading, I was going to mention, SPACs have had a really rough time, and I feel like you're one of the few that might I don't. Did you ever break below $10? That didn't trade below the issue price. Why is that?
Well, you're right. I think the SPAC index is down about 80%, but we use the SPAC as a way to get public, and it's really in the rearview mirror for me and for our team. We look at ourselves as the newest large-scale alternative asset manager, and we don't think we should be judged on the route, how we went public, but rather what are the fundamentals of our business. And I can tell you that we think we have something that is differentiated, unique, versus all the other alternative managers in the marketplace.